Hi, this is Mike Ward. I want to talk to you very quickly about our style engine. I want to give you an overview of the style engine that Chris Muller and I constructed, give you some idea of how this operates and some idea of its capabilities. Now, to start with, we need to talk a little bit about the metric that we want to measure. We want to start off by saying that we want to measure how businesses perform. We do this because businesses are the heart of the economy, and we have really good, accurate data based on shareholder returns, which enables us to measure what shareholders think. And remember, shareholders include most people who have pension funds and so on. And we've got a lot of effort and research and skilled people who try to determine what works and what doesn't work and pick the right companies. So we think this is a very good metric in which we can measure performance. Now, we include both components of share returns. We're interested in price appreciation, capital gains, if you like, and we include the dividends that shares pay in our measurement. We also have some data considerations that we need to talk about. We are very aware of a problem which besets many research studies, that of survivorship bias, where companies which have failed are not included in current studies. So when you look back, you only are looking at ones which have survived and you get a biased result. So we have gone to a lot of trouble to ensure that we have got all the companies that ever existed in our sample, and we include them and up until when they fail, including their final payouts, if any. We also control our data for corporate actions, things like share splits, acquisitions, mergers, spin-offs, all of those kind of things that also have a big impact on performance data. Our sample is essentially listed companies on the JSE, and we in particular focus on the largest 160 shares, although we can look at different sets of samples. And our data runs back to 1985. So we've got about 30 years of financial data to look at. Now, the kinds of questions that we're able to answer with the style engine, this methodology, are things like, do small companies outperform large companies? Now, this is an interesting question, and in many parts of the world it has been shown that small companies tend to do better than large companies. So therefore, maybe investors should focus their attention on those. So we can look at that. We can also look at another well-known style, if you like, investment style, and that's why this is called the style engine. Things like, do value shares with low price to earnings ratios, for example, outperform growth shares with high PE ratios. We can look at other questions like, do liquid shares, ones which trade frequently, outperform illiquid shares? Once again, there's been a lot of research done on something we refer to as the liquidity premium or illiquidity premium. We can also look at financial ratios. Are these useful for predicting portfolio performance? Should you buy shares on the basis of them, of companies which have high return on equity, for example? We can test these things. But beyond that, we can also look at other questions. We have conducted studies where we look, for example, do companies with more women on their board outperform? We can look at questions such as, does corruption pay? If you'd invested in companies which had since been fined by the Competition Commission, even after the fine, would it have been a good idea? Was the fine big enough? And so on. So there are many things that we can relate to the financial metric that we're going to be looking at. So let me just elaborate briefly on the advantages of the methodology, the style engine methodology. The problem that we face in financial research is that we have often are looking at very small effects, small changes in returns, if you like, from the things we're looking at, and the data itself is very noisy. There's lots of volatility in return data. So we solve these two problems using a methodology which has been around for a long time called buy and hold portfolio analysis, where we construct portfolios and we rebalance these and look at them over over a time period. Now, that's the essence of the style engine, which I'll explain in more detail. But the advantage is that we can accumulate these very small effects over a long period of time. Then you actually can see them. And we can get rid of the noisy data by constructing portfolios, which minimize the volatility. Some shares going up offset the volatility of other shares going the other way. So it's a powerful technique. Now, the style engine itself, just to give you an example, and we'll work through this example, I've picked this one. Do illiquid shares outperform liquid shares? And the first thing we need to define is how we're going to measure liquidity. And in this instance, we'll measure it by looking at the value traded by a company over a particular period as a percentage of its market capitalization. So we're going to go and calculate that metric every quarter for every company listed on the JSE going back to 1985. So our start date will in effect be the 31st of January 1984. We're going to go and find what were then the 160 largest companies that existed, and we'll include them in our sample. We then rank these from the most liquid to the least liquid. We put these into quintile portfolios, in other words, 5 portfolios, each with 32 shares in them, and the shares are going to have an equal weighting in terms of value in the portfolio. Then we track each quintile's, each portfolio's daily return starting from the 31st, or actually the 1st of January 1985, and we calculate the value of that portfolio based on an index starting from 1 at the beginning of our start period here, 1984, and we track the daily returns. And when we do that for a quarter, and on the 31st of March, we get to the end of our first quarter and we want to rebalance our portfolio. So we retain the value that we've accumulated from the beginning, and we then look to see what new companies have come into the data, and we again select the latest 160 shares that now exist. So some might have fallen out, some new ones might come in, and we will be accounting for the ones that have fallen out, taking into account what happened to the shareholders' returns when they fell out. We rank these again in the same way from most liquid to least liquid, and some shares will remain in the same portfolios, some will swap portfolios, some new ones will come in, and some new ones will go out. And we reconstruct our quintile portfolios. We re-weight portfolios equally so that we don't allow the big shares just to keep on getting bigger. And then we track once again each quintile's daily returns, in this instance, not from 1, but from where we got to last time. So if you like, we rinse and repeat this process every quarter, and we track the performance of our portfolios. Very simple in our outlay. So the result that we can look at is we're going to get a time series graph which tracks over about 30 years, and we'll get the daily value of every quintile portfolio, each of our 5 portfolios. We will have measured total returns, including dividends, and we will also be able to calculate the annualized return of each quintile over the entire 30-year period, see how they've done. We're going to include in our graphical plot the benchmark, which will be the all-share total return index, which will be market cap weighted in this instance. And in addition, we're going to construct what we call price relatives. We're going to take quintile 1 and divide it by the value of this by quintile 5. And you will see that this enables us to construct time series plots, graphs of outperformance, which can be very useful in looking at the results. So let me show you what this one actually looked like. So you can see here we are sitting in this particular instance actually at the end of 1985, and we have constructed our 5 portfolios here, and we're rolling them now through the first quarter over here. They're already starting to split up a little bit. And at the end of each quarter, we're going to remix, rinse, repeat, and so on here. And we're going to track these through now almost 30 years of data and see how they did. Now, you will notice over here the color coordination that we've got over here, from red to pink to brown to purple to blue, is in fact the wrong way around here. We see red, pink, brown, blue, and purple together pretty much over here. And this is the absolute inverse of the way in which we have set them out over here. So quintile 1, which is the red one here, which was the most liquid portfolio of shares, is at the bottom of our performance chart. And the two portfolios here constituting quintiles 4 and 5, the least traded, the least liquid shares, have in fact done the best. And you can't see here what the outperformance is, and I'll get Chris to put those things in for me, please. But what you can see here is the benchmark here, which is what you would have got had you just put your money, if you like, into the Satrix, or in this case, it's actually the all-share index, not just the top 40. And you can see that the illiquid shares outperform. It's also interesting to note that the sequence of these lines is exactly in this reverse order that we've got over here. Now, I want to draw your attention to this red line here, which is the price relative between portfolio 1 and portfolio 5. And this green line here gives us a very quick visual output of what we're seeing above. In fact, it's easier to read the green line than it is to see what's really happening over here. It measures, as it comes down over here, the gap between the blue line and the red line. And as that gap increases, which it does quite a lot over here, you'll notice what's happening here is the red line is going down a lot, whilst the blue line is going up here. It's telling us that this style, had you bet on it, invested on it, would have actually worked very well over this period. And it also tells you that over this period here, for example, the gap itself isn't actually changing much. So you can see, generally speaking, over the entire 30-year period, we do find that the illiquid shares have done better than the liquid shares. But you will observe that for more or less the last 10 years here, actually the gap hasn't been working. It hasn't made a difference. And the style, if you like, has stopped to work. So this is the type of result that we can get from the style engine. Now, let me just quickly mention some of the features to give you an idea of what the style engine is able to do. And perhaps the most important thing, and I can't overstress this, is that we've got clean data going back to 1985. We've taken quite a lot of trouble to ensure that we've got every share that ever was listed, that we have controlled for all the corporate actions. We've benchmarked our data in terms of returns and value against the JSE's indexes going back this far to make sure we haven't missed anything. So we've got very good data. Secondly, we're able to link the share return database that we're running all of this on here. It includes including dividends, that type of thing, to other data sets. So for example, if you wanted to see does return on equity drive share price performance, that's a different set of data. We then have to pull in from that financial statement data, and we're able to do that. We're also able to avoid things like the look-ahead bias. Although a company says its year end is, for example, on the 31st of December, actually you wouldn't have known that for about a month or maybe 2 months. So we usually build in a delay factor for other data sets which we may not have been able to get when you think you could have got them. And this is a problem that plagues a lot of research in this area. We're able to optimize the look-back period. In other words, if you wanted to, for example, measure a style such as momentum, over what period must you look at how well the shares did before you make your decision as to include them in the quintiles, rank them. We can also optimize the holding period, and we can change the rebalancing periods to suit. So that's a powerful and useful thing. We can also run overlapping portfolios. So we don't start up putting all the money into one portfolio. We can spread that over a period of time to avoid startup issues. We can include transaction costs. Obviously, we're able to measure how much of each share moved in and out of each portfolio. And one can include brokerage and taxes and, if you like, also market impact factors into the costs of doing this. We're able to use different portfolio weights. In the example I showed you just now, we used equal weights in the portfolios, but we can change these to Swix weights or to market cap weights, whatever is appropriate. We can also vary the sample selection criteria that we use to decide which shares we want to look at. We can look at just the top 60, or we could just look at mining shares, and so on. So those are some of the features that we can look at. Then just in closing, to show that we have found this style engine of ours to be very powerful, we have published a number of papers. These are some of them. The first one, which we published in 2012, was a graphical style analysis of the JSE, and we looked at many of the things we've mentioned here. We looked to see, does size make a difference? Does value outperform growth? And if so, when? Does liquidity make a difference? Do dividends count? And so on. You should go and read that paper. It's in the Investment Analyst Journal if you're interested. We've written a paper on the CAPM. Does beta work on the JSE? We've looked at BEE. Should you invest in shares that announce they're doing a BEE deal or not? We've looked at board diversity. Do boards with more women actually outperform? You may be interested to go and have a look at that. But we can also look at other things. And we, in fact, also make use of this in industry for ourselves. We, in fact, run, or Chris does, an equity fund based on the things, the styles that we know work. And, in fact, Chris also runs a long-short equity hedge fund where we bet on the things we know work in the long portfolio, and we sell the things that we find don't work, the styles where there's a big difference between quintile 1 and quintile 5. So I hope that gives you some idea of how the style engine works and what it can do. Thank you very much.